Hi, viewers. Welcome to the second episode of the Master Talk series. And this episode will be on fixed income investing strategies for a high interest rate environment, presented by the LSEC Group, providers of financial technology and data in association with Outlook Money. I'm Shudra, your host today. I am the South Asia sales specialist for the buy side at LSEC. In this session, we will cover the challenges and opportunities of fixed income securities in a rising interest rate environment and fixed income investment strategies. Our master for this session, let me introduce you to him. His name is Mr. Deepak Agarwal, the CIO of Fixed Income and Head Product at Kotak Mahindra Mutual Fund. Hi, Deepak.
Hello, everyone.
Mr. Agarwal manages 12 funds and all FMPs of Kotak Mahindra Mutual Fund. His career started at Kotak AMC when he joined the organization in December 2002. He was initially in research, dealing, and eventually moved into the fund management from November 2006. He holds a postgraduate degree in commerce from Mumbai University and is a qualified chartered accountant and a company secretary. He has also cleared AIMR CFA level 1. So the structure of the session for our viewers would be that I will be asking, we will do this via Q&A, interactive Q&A session with Deepak. Then we will go through some closing comments and we will close the session for you viewers. So Deepak, thank you for joining us.
My pleasure.
Before we begin the questions, how are you today?
I'm doing good.
That's great. So there's a lot of questions around interest rate. We are going through a period of high inflation globally. So what do you think? Do you expect this terminal repo rate that we are seeing at 6% is to stay in this rate cycle? Or can this go further up? How do you see the current interest rate scenario?
So let's say post the RBI Feb 2023 policy, we thought that 6.5% is the terminal rate. Basically, RBI has provided an average inflation target of 5.3%. And at terminal repo rate of 6.5%, the real rate is close to 1.25%. Now, according to us, that's an appropriate real rate, given that growth expectation for next year is between 5.75 to 6%. However, over the course of last 15 days, the data in developed countries in US has been relatively stronger, and inflation, the pace of disinflation has also reduced, which has led to expectation that Fed may raise rates by incremental 75 basis point over the course of next 3 months, and may take the Fed rate fund higher in the band of 5.75. Now, due to which the interest rate differential between India and US is reducing, which could put some pressure on our currency and may also have inflationary impact. And therefore, now we believe that RBI might hike rates by 25 basis point in the next policy, which is in April 2023, taking the repo rate to 6.75. Post that, we expect a long pause. And largely in calendar year 2023, our repo rate should be close to 6.75. Plus, what is happening that liquidity is getting tightened in the system. So even if, let's say, RBI does not end up doing incremental hikes, tight liquidity is going to continue to put upward pressure on the entire interest rate curve.
Okay, that's very good. So what we are trying to understand is, do you think that then the monetary policy, you see it stabilizing, or is there room for capital appreciation in the medium term for investors?
So basically, currently the yield curve is very flat. Now, we expect no cuts during the current calendar year. However, towards the end of the year, again, there will be expectation that Fed will pivot in towards the end of the current year or probably early next year. We expect RBI to ease with a lag. So there will be a lag with which RBI will be cutting rates or easing rates in India. There will be a lag. So during the current year, due to tight liquidity, first we expect some upward pressure in rates, but subsequently on expectation of Fed pivot and expectation of monetary easing by Reserve Bank of India, we could see capital gains in the latter half of the year. So yes, there is some scope for capital appreciation, but we believe that it may happen over the medium term and not in immediate future.
Okay, and that's very good because that sets me up for the context of actually the investment strategies that people can employ. So as you were correctly saying, the government bonds across all maturities are trading above the expected CPI inflation for the next year, even in nominal terms. And most of the government bond yield curves is in the 7.3 to 7.5 band. Given this, could debt fund be a really an attractive investment option? What do you think?
See, after the close to 250 basis point hike in repo rate by RBI from April 2022 till date, and based on RBI's forward-looking inflation for next year at 5.30, now based on repo rate, the real rate is close to 1.25%. And let's say, as you rightly mentioned, the entire GSEC curve, right from 1 year GSEC to 10-year GSEC is in the band of 7.25 to 7.5%. And based on forward-looking inflation, it's close to 200 basis point real rate. So yes, debt funds do investment in debt funds do make sense at the current juncture. Plus, we should also keep in, if we look that most of the debt funds in March 22, currently the portfolio yields are higher by approximately 200 basis point as compared to March 2022. So here investors are getting higher yield from debt portfolios, and plus they are getting a real positive rate of close to 200 basis point over forward-looking inflation. So yes, debt funds are attractive at the current juncture.
Okay, and so the sweet spot would be somewhere around the bonds with 5 to 7 year maturity. Is that what the strategy should be for investors?
So the yield curve currently is very flat, where let's say, as you also mentioned, that 1 to 10-year GSEC is in the band of 7.25 to 7.5%. And for last few months, we have been advocating that we prefer this 3 to 7 year segment. Now, most of our funds, if you see the duration, the portfolio composition is constructed with this 3 to 7 year segment part of the curve. So what we are, and therefore investors with 2 year plus investment horizon at the current juncture can look to invest in short or medium duration fund strategies. Now, mutual funds have also launched target maturity funds of 4 year, 5 year, 6 year maturities, which invest in government securities, state government securities. Now, investors with appropriate time horizon, in addition to short and medium duration strategies, can look to invest in these target maturity funds.
And hence the mutual funds play a big role because instead of taking direct position, you can have dynamic bonds, which have the flexibility of portfolio positioning as the market conditions evolve. Now, how do you think dynamic bonds suit to the requirement of long-term investors, especially in this volatile macro environment?
See, dynamic funds basically offers the fund manager flexibility to increase, decrease duration of the fund based on his interest rate view. Basically, the fund manager strives to generate alpha by actively managing the duration of the fund. So in this environment, what is our view? Our view is that probably for next 3 to 6 months, we could see some upward movement in yield curve due to tight liquidity and higher supply. But in the latter half of the year, or in the second half, or let's say over the course of next 12 to 18 months, due to Fed pivot and expectation of cuts, we expect yield curve to come down. So we believe that over the course of next 18 months to 2 years, you need to dynamically manage the duration of your portfolio. Our strategy in dynamic funds would be to gradually increase the duration of our portfolio over the course of time in case there is spike in yields. And therefore, in the current interest rate environment, investors with 2 year plus investment horizon can look at dynamic funds.
Okay, and that's very interesting because what I'm hearing is that you're seeing that peak interest rate is going to happen at some point of time, both based on Fed and RBI pivot. So yeah, go on.
So the point there is, let's say we may have the last rate hike next month in April, where the terminal rate could be close to 675. But our view is that any Fed pivot or easing by RBI is sometime away. And in the interim, due to tight liquidity and due to continuous supply, it may continue to exert pressure on short-term, it may continue to exert pressure across the yield curve. And therefore, one may get time to increase the duration. And therefore, dynamically managed funds a fund manager has the flexibility to increase the duration in case there is spike in yield. So it is up to the fund manager to add duration at the appropriate time or at appropriate juncture so that he can create alpha for the investors.
Okay, and so what in a way you're saying that instead of directly going into a short-term fund or a medium-term fund or a long-term fund and taking that decision,
Yeah,
appropriately invest in dynamic investment funds so that the fund manager themselves can move the funds as and when the market economics change.
perfect. So let's say currently, let's say ideally at current juncture, we are advising investors to select short duration funds. And we believe, let's say in case there is a spike in long-term yields, investor can choose a medium to long duration fund. And with every spike in long-term yields, the allocation to medium and long duration fund should keep on increasing. Now, dynamic fund is an opportunity where you don't have to do that allocation. The fund manager, based on the movement in yield curve, may do it for you. So a dynamic fund right now could be positioned, let's say based on the fund manager view, could be a short duration fund for you and may become a long duration fund based on the interest rate outlook of the fund manager.
Okay, that's interesting. But how do you see the risk appetite of the investors playing around this investment horizons? Because some investors are really, it's a developing market for bonds and fixed income. They are really about liquid funds and deposits. So how would you like to advise investors with shorter investment horizons and low risk appetites?
So currently, if you look even in the very short term space up to 1 year, the yield curve is practically flat. The 3 month to 1 year cost of borrowing for any bank or corporate is more or less flat at the current juncture. Typically, this is seasonal factor where liquidity gets tight. Now, starting April, we expect liquidity to ease and supply will reduce in the starting April. So the yield curve, which is flat, will steepen between, let's say, even in the short-term segment between, let's say, 3 months to 1 year, we expect the yield curve to steepen starting April 2023. Now here, the advice for short-term investors is select a portfolio based on your investment horizon, match the duration of your portfolio with your investment horizon. If your investment horizon is 1 month, liquid fund would be a better option. However, if you have an investment horizon of 3 months to 6 months, then one should consider money market fund and low duration fund over liquid scheme.
Understood. And so suppose so compared to this, how would your dynamic fund help? Should I invest now, or should I now park money in liquid funds and later on transfer that money over to dynamic funds after April in Q1?
No, so the advice which we are giving investors right now is one, you should match the duration of your fund with your investment horizon. So
Okay.
in case today you are looking to invest your funds for a period of 2 to 3 years, you could either consider a short duration or a medium duration fund, or you can also look at our dynamic funds where the fund manager will appropriately increase and decrease duration and try to create alpha for the investors.
And what are you hearing from your investors when you pitch this? What are the general questions or the concerns that you're hearing?
No, so of late, what we have been seeing that, let's say, as I mentioned to you, in March 2022, most of our portfolio yields or current portfolio yields are approximately 200 basis points higher than the yields which were there in the period, let's say, in the calendar year or financial year 21-22. So yes, corporates also believe that yes, after US raising rates by close to 500 basis point, it will result in some slowdown. We will see disinflation in US. There are expectations of rate cuts in US 12 to 18 months down the line, and similar expectation on rate cuts even in India. So yes, people are comfortable increasing the duration of their portfolio because the portfolio yields have also inched up by close to 200 basis point over the course of last 9 months.
And you're seeing all this mostly in the top line GSEC, or there's a sector in which the corporate bonds you think are doing better or worse in this environment?
So what we have seen, the credit spread has been relatively more or less similar as it was, let's say, in 21-22. So in financial year 21-22-23, the credit spreads are more or less similar as to what they were in 21-22. And over the course of next 8 12 to 18 months also, we don't see significant widening of spreads. Yes, liquidity is reducing in the system, which might put some upward pressure on rates, but we are not expecting any significant widening of spreads between GSEC and corporate bonds during financial year 23-24.
Okay, that's very interesting here. So I was just thinking we're coming to the close of our session. Do you have any closing remark or anything that you want to talk to the investors that they should be worried about or be positive about?
So no, the basic point is, let's say post-COVID, RBI had reduced rates significantly to support growth, and after due to which investors looking to park their money for a period of 2 to 3 years, FD rates were lower, and mutual funds portfolio yields for a high grade portfolio quality was in the band of 5 quarter to 5.5%. 12 to 15 months down the line, due to rate hikes by RBI in order to control inflation, investors are getting opportunity to lock in their money for a period of 2, 3, and 5 year or long term with a portfolio yields which are approximately 200 basis point higher. With their main investors should consider to lock in their investments at these levels and matching their investment horizon. There might not be immediate capital gains, but yes, the accrual is good. And over, let's say, next 12 to 18 months, when global central banks start cutting rates and Indian central bank also follows up, there are scope for capital gains as well. So yes, after 2.5 years, we are seeing such portfolio yields in high grade portfolio, and there is merit for investors to add fixed income allocation to their portfolios.
Understood. So that this was lovely hearing from you because indeed it gave me insight into the market. So thank you so much for giving time out of a busy schedule. And thank you, our viewers, to be here. And I hope we enjoyed our conversation today. This concludes this episode of Master Talk. Thank you.
Thank you.